Philip Fisher has been recognized as one of the greatest investors in history because he was one of the pioneers of growth investing with a long-term vision that he explained in his most important work, Ordinary Shares, Extraordinary Profits. His ability and strategy to identify and analyze companies with the capacity to grow quickly and generate profits for their shareholders is still studied by experts and analysts around the world. This is the history and investment philosophy of one of the best fundamental analysts in high-growth companies on the stock market in the United States. Fisher was born in the city of San Francisco in 1907. Since he was a child, he showed in school that he had a great ability for mathematics and numerical analysis. Due to his tremendous academic abilities, he managed to graduate with honors from school at the age of 15. But his great intellectual abilities led him to be a rather introverted young man and to have difficulties socializing with his classmates. Philip preferred to be alone, devoting time to reading different books, which allowed him to have knowledge in different areas from a very young age. Due to his tremendous academic abilities, he was accepted by the University of Berkeley to begin studies in economics. But thanks to his extraordinary performance, he decided to transfer to the prestigious Stanford University, where he finished his degree with outstanding grades. As an economics student, he already began to carry out the first stock analyses, especially focusing on small local companies. The skills he managed to develop from the beginning were the basis for consolidating the investment strategy that strengthened his career. From a young age, Fisher already showed a special nose for finding companies to invest in that later had extraordinary growth. His first job was in 1928, when Fisher joined the Anglo-London Bank in San Francisco with an initial position as a securities analyst. He worked there for nearly 3 years, once again demonstrating his ability to analyze company stocks, especially small companies with growth potential, demonstrating his ability to find companies with the capacity to grow and have good results in the long term. With some experience, he became independent in 1931 to start his own investment and wealth management firm called Fisher & Company. Even at the end of his life, at more than 90 years old, he continued to lead his firm for almost 70 years, consolidating his investment firm as one of the most important in the world. At his firm, he managed to fine-tune his investment strategy, which was a mix of fundamental analysis and analysis of the competitive advantages of companies. His magnificent results allowed his firm to obtain an excellent reputation due to its tremendous results. Throughout his life, he kept a low profile, which to a certain extent did not allow him to have more recognition because he was not a big fan of interviews and public outings, and he even took the pleasure of selecting the clients he advised. A good part of his investment strategy and philosophy is explained in his work, Common Stocks, Extraordinary Profits, where he establishes the foundations of the quantitative and fundamental analysis that he used to study the companies in which he preferred to invest. This extraordinary work for many establishes the principles for fundamental investment based on growth, where one seeks to find small companies, which have high expectations of growth in the medium and long term, while at the same time, to balance the portfolio, more consolidated companies with stable businesses, and even with the possibility of growing at good rates were also selected. At the time, well-known examples were companies such as DuPont or IBM. His strategy focused on finding companies with very high growth prospects in the medium and long term, without the need to diversify too much. To do this, he concentrated very carefully on selecting the best positions, taking into consideration the search for a good entry price for the action. For Fisher, an optimal investment portfolio should have between 10 and 12 companies from different sectors. If there are more than 20 companies, the potential for appreciation of the selected companies is possibly diluted. For Fisher, it was much more profitable to invest in companies with a high growth potential than in undervalued companies with little growth, since in companies with little growth with a 50% drop, the appreciation potential was little more than 50%. While on the other hand, if companies with the capacity to grow were found, the appreciation potential was even that of multiplying the invested capital by 10 or more times in the long term. Fisher tried to have a little diversified portfolio, focusing on innovative companies, which would allow them to maintain competitive advantages in their sector with solid management teams, with high growth prospects. Fisher's strategy had a long-term vision, avoiding short-term changes in stock prices that would lead to selling positions. Rather, he focused on reviewing its history of growth and profits, as well as the solidity of the business models that would allow it to have increasing profits in the long term. Even the great Warren Buffett, in one of his interviews, admitted that in his investment strategy, one of his references was Philip Fisher, along with the legendary Benjamin Graham. In his renowned work, Common Stocks and Uncommon Profits, Fisher documents his investment strategy in detail, where he has as a reference 15 questions that Fisher formulated to analyze the companies in which he sought to invest. These 15 questions that Fisher managed to identify to evaluate whether a company was a good investment alternative were designed in part based on the original ideas of other investment advisors with a recognized track record who were known as key investors, who preferably focused on studying the type of stocks that he also followed and who in some cases published analyses of these companies. Fisher was trying to find companies with high growth potential, but also companies that were in sectors with unusual growth opportunities, where it would not be so easy for competitors to enter to compete. In these questions, Fisher sought to observe whether the companies analyzed offered services or products that had the potential to grow in the market segment in which they operated, which in the future would allow them to increase their sales in a sustained manner in the following years. Another element to analyze was whether the company was investing in developing innovative products that in the future would allow the company to increase its sales with sustained growth. This implies that a good part of the benefits are reinvested in R&D, research and development, to guarantee that in the future the company would offer innovative products and services with an advantage over its competitors. But for Fisher, it was not enough for the company to invest in research and development, since it was essential that the investments were evident in the results of the products or services launched on the market. In this sense, a good strategy was to observe whether the sales of the companies analyzed were above the average of the companies in the sector, which allowed to observe that it had some competitive advantages, while observing whether the company had good or excellent profit margins on sales. Additionally, Fisher checked whether the company continued to seek strategies to improve or optimize the profit margins that it currently had. It was important to check then whether the company managed to produce with the lowest costs in the sector with respect to its competition, since this would offer it a competitive advantage in relation to its rivals. On the other hand, Fisher reviewed the sales capacity of the companies, identifying whether the organization had a marketing structure to study the needs of the clients with efficient product distribution systems. The other element that Philip tried to study was the administrative component of the company, identifying whether there were good relations between the directors, which allowed to observe good management, which were reflected in cost analyses and clear, reliable, and transparent financial statements for the shareholders. In addition, companies were required to have a good sales team that would allow the company to better achieve sales expectations. In this same administrative component, Fisher looked for companies that were run by managers who had the ability to clearly explain to investors the reality of the company, showing both the positive aspects and the negative elements in case of going through adverse times. Fisher was able to identify management teams that, because they sometimes hid information, did not allow shareholders to generate certainty regarding the honesty and integrity in the management of the company. In this case, it was better not to invest in that company. For Fisher, good leadership in companies promotes the development of the necessary relationships so that products or services continue to be developed with innovation and competitive advantages, which allow long-term growth, adapting to the circumstances of dynamic markets through the design of successful plans and strategies. At the same time, companies should have a management team and system that had a very high reputation, both from an ethical point of view and from the ability to properly manage the company. Among the accounting elements, Fisher placed special attention on analyzing whether the company needed financing and, if so, whether the increase in debt would affect the company's profits or whether the current shareholders would be diluted with new share issues. Whether the company was able to finance itself was a good indicator of its ability to create value for shareholders. Along the same lines, it was very important to try to observe whether the management's vision regarding profits was short-term, or whether, on the contrary, there was a long-term strategy that privileged growth and investment in development. On the other hand, in relation to the analysis of the company's competitive advantage, Philip Fisher looked for companies that had better prospects than their competitors, which would allow them to increase their sales and profits in the long term. For this exercise, it is necessary to review whether the company's net profits in the last 10 years were the result of investments in research and development. Fisher assured that companies with good performance in the past may not necessarily have the same result in the future. This qualitative analysis should be in line with accounting results that allow us to see that the companies in which we invest have profitability levels above the average, reviewing the profit margins on sales and comparing them with rival companies in the same sector. Old companies may have higher margins, since young companies trying to enter a market must invest more in research or marketing. In some cases, when there are high profit margins, there will be a greater number of competitors trying to take market share from consolidated companies. But if we manage to operate with high levels of efficiency, we can limit the entry of new competitors. Another element that we took into account was to evaluate whether the company could protect its competitive advantage and its market segment with skills, innovations, or protections, such as patents for its developments and research. His investment strategy was complemented by a high capacity for emotional control. According to Fisher, in order to invest in the stock market, it was more important to have a very good emotional and nervous system, above the capacity to analyze and review companies. This emotional capacity allowed him to make investments against the masses, which led him to make aggressive purchases in times of extreme pessimism, taking advantage of opportunities. Although Fisher advocated long-term investment, he stated that in some cases investors can sell a company's shares if it is evident that the initial evaluation of a company was carried out incorrectly, and it is observed that the company's fundamentals are not in accordance with the analysis carried out, and it is better to buy other opportunities with greater potential for appreciation. An adequate period to evaluate whether the company's results and earnings are as expected is at least 3 years, a period in which in some cases it is logical to sell a company's shares if the expected behavior is not observed. But if a serious investment error is evident, Fisher recommended selling as soon as possible. Another component of Fisher's strategy was to try to obtain classified information about the companies in which he intended to invest. The great majority of this information was obtained informally through conversations with people who were related to the companies under study, or through direct visits to the offices of the companies and even their production plants. This technique was known as rumor-based and allowed Fisher to complete his quantitative analysis of the companies, allowing him to carry out a qualitative analysis, which would account for the culture of the companies and the dynamics within each organization, in addition to knowing the details of the evolution of the development of new products and services. To this end, Fisher managed to arrange meetings with different employees and directors of the companies, as well as interviews with competitors to have a broader view of the entire sector. This information gave Fisher a competitive advantage, because these indicators were not available to other analysts in financial reports and other public documents. Searching for company information in alternative sources to traditional reports allowed Fisher to consolidate his ethical investment philosophy, where he sought to invest in companies that, in addition to having unique, high-quality products, had management teams that sought the well-being of employees. This position is one of the foundations of what is currently known as ethical or socially responsible investment, where one does not only invest to make money. For Fisher, it was essential to review a company's history of ethical and responsible behavior, in addition to the company's transparency. For Philip, the decisions made when investing in the stock market should be based on the data analyzed, seeking to avoid the emotional component influencing the decision-making process. Another of Fisher's great teachings was to achieve a high level of patience when investing in shares, because in some cases when undervalued companies are purchased, a very long time is needed for the market to revalue the fundamentals and allow the stock to reach its real price. Philip Fisher is known as one of the fathers of growth investing, along with Thomas Rowe Price. The strategy is to look for companies that have a high potential to continue growing in the long term due to the competitive advantages over rivals in their sector. Fisher, like the great Warren Buffett, sought to invest in a company where he could keep the shares for long periods of time, benefiting from its growth and appreciation over long periods of time. This allowed him, in addition to multiplying his investments several times over, to have significant savings in the payment of taxes that are settled at the time the shares are sold. Unlike other well-known investors, Fisher tried to avoid investing in companies that offered high dividends to their shareholders, because to achieve high growth, companies were required to reinvest in research and development to dominate a market and maintain competitive advantages. One of his most memorable investments was the purchase of Motorola shares, which he acquired in 1955, an investment that he maintained until 2004, the date of his death, achieving excellent returns with this action thanks to the patience of maintaining the investment over the long term. To give an idea of the successful investment, the purchase price per share was $4, reaching the company's price in 1999 to exceed $200 per share, multiplying its value by 50 times. Currently, the company's shares are quoted at around $450, multiplying its value by more than 100 times. One of the reasons why Philip decided to invest in Motorola was because he observed that it was a company that invested in continuous development to design new products and technologies in the telecommunications sector and the consumer electronics market. The relationship with the company was quite close, influencing the selection of managers and leaders. He was also recognized for observing the growth potential of an electronics company called Hewlett-Packard, which he personally visited in 1954 to meet with its founders. Other companies where Fisher managed to multiply his investment by more than 5 times in less than 3 years were companies such as Disney, Texas Instruments, IBM, DuPont, and Dow Chemical. After his death, his son Kenneth Fisher took over the reins of Fisher Investments, and the firm continues its activity in the management of investment portfolios for institutional and personal clients. In the description of the video, you will find the link to the best platform for investment stocks on the regulated stock exchange in the United States. There is also the best course to learn technical and fundamental analysis to buy stocks. And finally, if you want to support us, there is the Patreon account so you can support us in creating more content.